Welcome, young investors. My name is James Fletcher, founder of Young Investors Society and portfolio manager. And in today's unit, we are going to learn about how to find companies to invest in, one of the key things that we are always asked by investors. So in lesson number 1 today, how do we come up with investment ideas? Our objectives during the lesson are, first, we are going to identify businesses that have a competitive moat that may be good investment targets. And 2, we are going to play around and have fun with some stock screeners to start to evaluate stocks to invest in. Before we start, let's show a video, and this is a video of me talking about how I come up with investment ideas. And it uses the example of Peter Lynch when he invested in Hanes, and he created the adage, invest in what you know. So let's introduce this segment this way. Okay, young investors, welcome back. In this unit, we're going to start preparing our stock portfolio. Looking for good companies is like looking for buried treasure. Identifying an exceptional company is rare, but finding an exceptional company that is on sale is truly a feat. The good news is it's not impossible. So like any good treasure hunter, it's important to pay attention to your clues. One common investment maxim is to invest in what you know. Legendary investor Peter Lynch, who averaged a 29% return per year over 23 years at Fidelity, tells the story of his wife coming home from the grocery store and mentioning a new product that she was excited about, pantyhose in an egg-shaped case called Legs. She raved about what a great product they were, and he also noted that because they were sold at the grocery store, she was picking up more pantyhose than ever because she would visit the grocery store twice a week compared to the department store, which she visited maybe every other month. With this knowledge in hand, Peter began aggressively buying shares in Hanes, the maker of the Legs pantyhose. The stock became a 30-bagger for his fund, meaning that it didn't just double or triple, it went up 30 times. And he found that idea not from the Wall Street Journal, but from paying close attention to what products people around him were using. So invest in what you know, but also be careful. Because the truth is, if we bought everything we knew, we would end up with a rubbish portfolio. For example, let's go back to the year 2000, where we shopped at Sears, we surfed the internet using Netscape, we took pictures with Polaroids, we bought GM cars, and we flew with Delta Airlines. All right, sweet, right? Load up a portfolio of things we know. Think again. The problem is that many of the companies the average person knew back then would all go bankrupt the following decade, and we would have lost all of our money as stock investors. So just because something is well known doesn't mean that it's a good business. Great investors do their homework and identify the treasures from the duds from all the companies around them. Remember golden rule number 4, know what you own and know why you own it. So the deals are out there, you just need to know where to look. And in this unit, we'll walk you through some of the ways that great investors go about looking for companies to invest in. Finding great stocks doesn't require a treasure map, just a little bit of searching, some diligence, and a lot of homework, but it's certainly worth it. So grab your bullwhip and your fedora, and let's start treasure hunting. Welcome back. So let's think about the products that we know. If you're learning on your own, take a minute and write down a list of products that you constantly spend your money on. If you're in a group, you may make a list on the chalkboard or on a list as a group, and make a list of products that you are constantly spending your money on and are a key portion of your budget. So these could be shoes, these could be headphones, this could be your Netflix account, this could be television, this could be travel, this could be cars. Think about your monthly expenses. Think about what products you spend your money and your time on and why these products are valuable to you. So take a minute now, come up with a list of a couple companies. When you're done with that list, then think of one company that you think on that list would make a great investment. So not just a brand or a company that you use every day, but that you also think would make a great investment. take a while to think and defend it. You can defend it to a partner or defend it to the class or to yourself about why you think that stock would make a good investment. Peter Lynch talked about investing in what you know, and we talked about that example of Hanes, where he saw that his wife and her friends were crazy over the leggings from Hanes brand, and this is what sparked the idea for him to invest in Hanes. Do you agree with this statement of Peter Lynch, investing in what you know? Is it always great to invest in what you know? Sometimes a popular company does not make it a great investment. And we talked about Netscape or Kodak or Delta Airlines. Sometimes just because a company is popular in the moment does not make it a great business. It may have a lot of debt, it may have a lot of competition, or the industry may change dramatically in the future. So a popular company does not necessarily make for a great investment, which is why then we go to our last unit, which is economic moats. So if it's popular, and it has an economic moat, then we may be onto something. So what are the moats that we're looking for? Intangible assets or brands, high switching costs, network effects, or low cost advantage. As a portfolio manager, I'm constantly looking for investments. And one of the ways that I can look for investments is to look through the lens of a moat. So what are businesses that would have these various moats? What is a business that would have a brand moat? What is a product that I am happy to pay a premium price because I believe in the quality? What is a brand that has a high switching cost? What are the products in my life where I am very unlikely to switch because they provide a good product and it would be a huge pain to change out of that product, whether it be a bank or TurboTax every year, where I just consistently stay with it because of just the pain in switching. Network effect, think about it through the lens of a network effect. What are products that I see around me that I am on the platform or I am using the service because others do? Maybe I am using Android because my friends use Android, and so that creates that network effect. Or I'm on this social network because my friends are, that creates a network effect. And then the last one is low cost. So what are the items that I buy because they're the lowest price? So maybe I go to Walmart because it's the everyday low price, and Walmart has a structural cost advantage on their supply chain. Or maybe Amazon, due to their free delivery, gives me the lower cost. So that's one way to think about businesses. Now, we have in the link, click on handout 4.1, and this is what we created for you, is a cheat sheet for helping you come up with investment ideas. So the first question is, you should ask yourself is it a good company? And there's various metrics that you can use to identify with here. So the first one would be the ROE. So maybe we're looking for an ROE above 12%. The other one that we may be looking for is high margins. So another thing that indicates a good company is their profitability. So we want a gross margin above 30% or an operating margin above 15%. Good companies also tend to have low debt levels, so an interest coverage, so they can pay their interest payments every year, 3 times indicates their cash flows are at least 3 times more than their interest payments. And then the fourth one we may look for is just stability, so stable earnings, stable ROEs through the years and a long history. So those are some of the numbers that we would look for to determine, is a company good? The second question we may ask ourselves or we may evaluate is the company growing? Remember that stocks follow earnings, so if earnings are growing, very often the stock is growing. So here are a couple metrics that we can evaluate, is the company growing? We can look at the company's 5-year growth rate. Is it greater than 5% per year? So are they growing more than the GDP in that country? We can look at their revenue growth. We can also look at their earnings growth and their EPS growth. So are they able to grow their profits even more than their revenues? Are they able to grow their profits more than 10% per year? And then we can forecast and think about, do we expect this growth to be consistent and high into the future as well. A third question we would ask ourselves is the stock cheap? Are we getting a bargain on the stock? And oftentimes we'll look for stocks where we can get a bargain. So what is a bargain? Maybe it's a PE ratio below 15 times, which is the market average. Or maybe it's a dividend yield, so our average dividend return is above 3%. That is a factor that we could screen for. Or price to book ratio, can we buy it at a price to book below 2 times or below 1 times? So these are some of the items that that me as a professional investor are helping you see what are the key factors that we can screen for. So now I want to encourage you to do an activity. If you're in a classroom, do it as a group. If you're learning on your own, then take a minute and take these variables and go to a stock screener. So a stock screener is a way that you can filter out and screen through thousands of companies on characteristics that you want. It's a lot like picking out a car. So if you're looking for a car, you're maybe looking for a certain color in a certain model that has a certain low mileage, has a certain horsepower, and then you can put it all in a system and it will filter out and give you the best combination of these factors. Stock screeners can do the same thing. So one stock screener is Google Stock Screener. You can go to google.com/stock screener, or you can go to Zacks.com or Yahoo Finance. Guru Focus has a stock screener. But let's do that right now. So let's go through that stock screener. Let's take some of the variables that we talked about and let's play with them. And let's see if you can narrow it down to a list of companies that you may find attractive. Maybe you want to say, I want a company that has an ROE above 20% and I want to pay less than 15 times PE ratio. So then you screen for these two factors, ROE above 20%, PE ratio below 15 times. Or let's say you want a growth company, a company that's growing. So you want to screen for growth above 15% on average over the past 5 years, and we want to pay less than 20 times PE ratio, or maybe 2 times price to book for this growth of the business. Take a minute, play with it. Take 10, 15 minutes and start familiarizing yourself with the stock screener. At the end of the stock screener and at the end of this exercise, you will have identified companies that you think are interesting investments. And this is a starting point for investors to start doing research on companies. For you young investors, this is a great way to start thinking about what company you want to pitch during the YIS Global Stock Pitch Competition. Every year during April and May, thousands of kids throughout the world are choosing stocks to do presentations on that they think are good investments. And stock screeners are a great way to start by finding companies that either have high quality, high growth, and at good valuations, or a combination of these, and through products that they know and that they love. After you've gone through the stock screening, look at your list and look at the factors that resonated with you. What does this tell you about who you are as an investor? Do you tend to gravitate toward growth companies? Do you tend to gravitate toward very high quality companies, stable companies? Or do you tend to gravitate toward very cheap companies? There are great investors that have made their money all sorts of ways in the stock market. In general, a growth investor tends to focus on the growth of companies. So they tend to look for companies that are growing 15% per year, 20% per year. They may look for companies that have very high gross margins that are still able to grow. And these you would classify as growth investors. There's also a set of investors called deep value investors. And these are companies looking for deep value. So they're looking for cheap companies, maybe a PE below 12 times or 15 times, a price to book below 1.5 times or 1 times. If you gravitated toward this, you may be a deep value investor. Reflect on your activity and think about what type of investor that you are. So I hope this has been helpful. You've gotten a glimpse into how investors find their best ideas. We've gone through Peter Lynch. We've gone through some of the factors that we screen on as investors, and hopefully through this filtering process, you've been able to identify some great potential investments for you in the future. All right, let's take some frequently asked questions about going through the process of finding ideas and doing stock screens. So the first question that we received is, there are many ways, many valuation techniques. We tend to use PE ratios. Do you use PE ratio for all companies, or do you use other techniques for different companies and industries? It's a great question. So PE ratio is our go-to method for evaluating companies, whether they're expensive or cheap. But it is not the end-all be-all. And in some cases, other valuation techniques are better. So asset-intensive businesses, companies that have a lot of assets, like manufacturing companies or materials companies, they tend, and also companies that cycle and go up and down their profits. So some companies may make no profits for 2 years and then may make big profits for 1 year and then no profits again. And in this case, a PE ratio, because the earnings will be 0 for those 2 years when they're not making profits, is not an indication of how much that business is worth, right? So oftentimes on both asset-intensive businesses, which has a lot of assets or plants or materials or resources, or cyclical companies, you may use a price to book. And the price to book is PB, and the price to book multiple will evaluate the stock price over its equity value rather than its earnings that year. And equity value tends to be more stable, tends to reflect the long-term assets of the business. There's other instances where you may use a price to sales multiple. One instance is a tech company. So a lot of these SaaS companies or biotech companies that are growing very fast but have no earnings because they're still in their growth stage. If you use a price to earnings multiple on negative earnings, that doesn't help you very much. And so a lot of analysts will use a price to sales on these high growth businesses that are expected to generate big earnings in the future, but at current rate are just growing their sales. So you would use the price over their sales. There's many valuation techniques, and we can discuss them more in depth. But in general, when you look at a valuation multiple, look at the company's history. So look at its historical range of where it's traded, and is it in the upper end or the lower end of that range? And also look at the company's peers. So look at the peers that it competes with in their own market, and look at global peers and see what these companies tend to trade at. So Coca-Cola is a beverage company. You would really want to look at what Pepsi trades at, or Dr. Pepper Snapple. And these would give you a good indication of what is the correct multiple to use, and is this cheap or expensive? Okay, so the second question we received is paying dividends important? So you talked about dividend yield, James. Is paying dividends important? Like we talked about, there's different type of investors. Some are growth investors. So in general, growth companies tend to be growing their sales very fast and reinvesting their profits into further growth. And so growth companies tend not to pay dividends. So growth investors, for the most part, are not too concerned about whether the company pays a dividend or not. They just want the company to grow. Whereas value investors will tend to prefer a dividend. And there's a subset of investors that call themselves dividend growth investors. And these are investors that want profitable cash generative companies that are paying consistent dividends. And in that case, using a dividend yield, or how much dividend you receive over the stock price, is a good indication of the value of that company. So if you're getting a 3% dividend yield in a business that is still growing, you're getting back 3% interest on your investment every year. So that's a great question. The third question is interest coverage. What does that mean? And I don't understand that term. So interest coverage is a gauge that basically shows how much operating profit the company makes, so how much cash is left after selling the goods, the revenue, and then the costs of that revenue, so your operating profit and paying your employees. And then below that is how much interest expense you have to pay on your debt. And you're in big trouble if your interest payment is higher than how much profit that you generate. Just like if you were a person, and if your debt that you owe on your house and your car, your monthly payment, is higher than your discretionary income after your salary and taxes, you're in big trouble because you can't meet those payments. And so an interest coverage is how much higher is your annual cash flows above your interest rate required. And so if it's 10 times, then you have 10 times more cash flow than you need to make your interest payments. If it's only 1.5 times, then it's very narrow, you're cutting yourself really tight, and maybe a downturn in the economy may make it so you can't meet your debt payments and you could go bankrupt. But in general, when you see a term like interest coverage that you don't understand, I'd encourage you to, one, check out the Stock Investing 101 ebook on YIS.org, and we have a glossary of terms at the back of that. And two, Google and Investopedia are tremendous resources. So anytime, especially now when we're in the thick of it of finding companies, reading research reports, working on our stock pitch, feel free to go on Investopedia, Seeking Alpha, and read about these terms, read about how other investors describe it. And you're now at the stage where you have enough knowledge that you should be learning these concepts on your own as well. And so that is interest coverage, but I'd encourage you to explore all of the terms which you don't understand. So I hope that helps, and I hope you're well on your way to finding great companies.